Welcome to the Shoreline Maritime Risk podcast. In each episode, we'll look at real-time case studies, current events, and speak to the experts dealing with critical risks at sea. What really happens when a crisis strikes at sea? And what can you do to protect your ship?
Good day and welcome to the 9th episode in Shoreline's Maritime Risk podcast series. Today we have the pleasure of speaking to Tom Quay. Tom is an expert in all matters relating to cyber insurance and reinsurance and acts as the cyber practice leader at AcrisureRe in London. AcrisureRe are the chosen broker for Shoreline's placement of reinsurance, which supports the ongoing provision of their maritime cyber insurance solution to their ship owner clients. And it's with great pleasure that we have the opportunity to speak with Tom today in order to get a snapshot and update on the current state of the cyber insurance market in London and the rest of the world. So, good afternoon, Tom. Thank you for joining us today on Shoreline's Cyber Podcast, where we intend to look at the current state of the cyber insurance and reinsurance market in the London market. So I'll start by introducing you. You are our trusted reinsurance broker. You are the cyber practice leader for AcrisureRe. And of course, both your company and our company have shared parental ownership by the Acrisure company in the US. So we work very much as colleagues on the placement of this maritime cyber insurance. And we look forward to hearing really your comments on a very changeable reinsurance market in London at the moment. As you know, we came to London a couple of weeks ago to see you and your colleagues, and we got a very clear picture from both yourself and our reinsurers about how difficult the market is at present and the current issues that they face in terms of the availability of capacity, etc. And we thought because a lot of our ship owner clients are now looking at the provision of maritime cyber insurance to protect their companies, they do so at a time when the market is becoming somewhat constrained. And so we thought it would be helpful just to reach out to you to give us your expert opinion on what is happening here and now in the market and how the market might look going forward, say 6 months or certainly beyond 1/1 next year. So be very welcome to hear your thoughts and comments on the current state of the cyber insurance market. Over to you.
Thanks, Tom. Thanks for having me. You're absolutely right. With our shared ownership and our position at AcrisureRe with the Actual Group and the vision and of the business that we handle within Acrisure, both in the US on a retail basis, but also in our wholesale division in London and our reinsurance division and offices around the world. We've got quite a good view of the cyber market, both from an insurance and reinsurance perspective. And so, hopefully you can give some, updates on where we are and perhaps, how we ended up, where we are. I think, the first thing to say is that, there's been a rapidly, evolving threat landscape in cyber over the last, 3 or 4 years. And with that has come, fairly, rapid deterioration in the underwriting results of a lot of the cyber insurers around the world. As a risk, as a insurance line, the exposure and the losses have started in the privacy arena, where people were buying cyber policies 4 or 5 years ago to protect them from privacy liability claims and data breach costs and fines and penalties, but more recently evolved into more of a first-party crime and ransomware, ransom payment type loss exposure, which now is impacting a much broader spectrum of industries around the world than perhaps previously, when it was more privacy focused on data-rich businesses. And I think that's key because the product line is now increasingly more relevant than ever to those businesses outside of the retail sector and the healthcare sector, for example, and especially important to the marine sector now, where the reliance upon networks has increasingly important. Why is that threat landscape changed? Well, underlying this market is primarily driven by the economical benefit of criminal organizations and other threat actors, and how they deem the value and how they extract the value from their targets. So if you go back 4 or 5 years ago, data theft was the number one way to extract value. So theft of credit card details and theft of social security numbers and other data that can be used to clone identities and take money off of bank cards and be sold on the dark web. That is still an issue, but the value of that data has arguably reduced because of the supply and demand economics, and therefore we've seen a move towards the monetization of the locking out of computer networks and the direct theft of funds from people's systems and banks, and that's why this evolution has occurred. In the end of 19 and into 2020, we saw rapid deterioration in ransomware losses, and it was already a trend of the criminals to steal and obtain financial gain from locking people out of their networks. But the move to remote working and the reduction in levels of security brought on by this, with people moving to work from home from laptops, which perhaps weren't as well protected as their home networks, really exacerbated the already growing issue. That very high level overview leads us to why we've seen a very dramatic correction at the back end of 2020 and into 21 in terms of both rate, with rates now arguably on average up 40 to 50% in 2021, with some sectors more hard hit in terms of rate increase than others. But also we're seeing a greater focus on risk selection. So there are several cybersecurity minimum standards that almost all markets now require to be hit in order for terms to be offered. Equally, we've seen a restriction in terms and conditions, with a focus now on sublimiting specific costs and expenses, for example, ransom payments, and equally a tightening of terms that perhaps were broadened out during the softer markets in the years preceding 21. And then lastly, and quite importantly, and this is tied to rate as well, we've seen a significant reduction in limit profiles deployed by our cedents and also on the insurance side of the business. This is, if you think about it in the Lloyd's context, for example, many of our syndicates in London were only given 20, 25% perhaps growth this year, and with rate increases tracking at 30, 40, 50%, depending on the book, there is limited room for growth. In fact, there is no room for growth, and therefore they are either having to come off risks if the minimum controls aren't hit, or equally they're having to halve their lines or even reduce it further. That's having an impact on the whole market in terms of supply and demand of aggregate, because people they bought significant limits are now not able to access that, and people are having to pay more in order to access the limited supply of capacity, and that's compounding the rate increases we're seeing.
And I think that really is a sort of whistle-stop tour of the contraction of the market. And if I can sort of summarize and paraphrase what you're saying so that I can get my understanding right. I mean, this was ostensibly an emerging market some years ago with fairly good loss ratios due to the sort of change in the in the attack vectors and a move towards ransomware. We now see a proliferation of losses in the market with perhaps higher limits than had been originally anticipated, because I know that back in the day when the ransomware attacks first emerged, they were for very small quantums of money, and now we understand they've increased quite significantly. This has obviously changed the underwriting perspective in the market in terms of, as you say, they've been tightening up these minimum requirements in terms of how a company safeguards its cyber resilience and what security checks it has in, and checks and balances it has in place. And there are we've certainly seen that from our perspective. These minimum requirements have increased quite significantly. You talk about the fact that the supply and demand issue is beginning to bite on rate, and as you say, that 40 to 50% increase in rate is quite eye-watering from an insurance buyer's perspective, but from the capacity provider's perspective, it's perfectly understandable. And the fact that because there's been a sort of increased demand for this insurance and the capacity hasn't flowed in the same way, that availability, just simply economics, has meant the rate has had to increase, and the rate seems to be now deployed to existing business rather than new business, as I understand it, certainly through to the beginning of next year. And I think some of these issues are relevant to our client base. Certainly in respect of the minimum underwriting guidelines required for us even to provide a quotation. We do find that, although I think it's well publicized that the ship owning industry sector have been fairly late adopters of risk transfer and the acquisition of cyber insurance covers to transfer this risk out of their businesses. We are beginning to see them, perhaps prompted by A, the proliferation in attacks on the industry, and B, the regulatory requirements from the IMO. We are beginning to see ship owners taking a more proactive stance on security measures and making sure that their systems and networks are properly protected. Maybe just want to touch upon how those minimum requirements have changed. What the sort of minimum prerequisites really are. That would be helpful.
The underwriters are learning about these new threats as they experience them, because it's what's going to happen in the future that most of the underwriters are concerned about, and they're trying to avoid that as the threat evolves. So, initially, and all of these are minimum standards, but I'll talk through them in terms of how they've kind of evolved as the time has gone on. But initially, the focus was on remote access to the network, the corporate network. So with the move to remote working, people accessing the corporate network from their laptops or mobiles or otherwise, there is now a pretty firm red line in the sand that multi-factor authentication needs to be used in order to obtain access to the network. Primarily that's to avoid the threat of a stolen credential being used to access very easily a corporate network, which we saw in, for example, the Colonial Pipeline attack in the US, which resulted in significant costs to that insured. Within remote access, there's a further focus on what we call remote desktop protocol, which is another form of remote access, but equally allows the user to remove laterally within a corporate network. So there's a requirement for multi-factor authentication to be then required for the RDP protocols as well. We've then seen a focus or a move, an evolution into a focus on what insureds are doing with regard to backups. So should a adversary be able to get onto the network and be able to have a look around the network for valuable data or systems or applications in order to encrypt them, underwriters are now keen to understand how quickly an insured could recover from or recover their critical data, if not more data and applications from backups. So, it's no longer acceptable just to be taking quarterly backups. More regular backups of critical data are required, and the protection of those backups is being heavily underwritten. So if they're online, but perhaps offsite in the cloud, then encryption, again, multi-factor authentication to access those backups is required. In an ideal situation, critical data is backed up offline, so not attached to the network and stored on a tape drive, encrypted, and therefore not easily corrupted and easily brought back onto the network, should that be a more efficient way of getting the system back up and running. And they need to be regularly tested, these processes. I think as the evolution of these losses has moved on, underwriters have realized that, just encrypting your backups is not good enough. They need to be tested, because there have been examples of people testing their backup procedures and realizing that the encryption key for their backups is stored on the network, and therefore the backups are unencryptable. They can't get access to the backups because the key is encrypted by a potential ransomware on the network. So things like this, and working through the playbook, understanding actually how quickly those backups could be uploaded onto the network from an off-site location. Sometimes that takes quite a long time. So working through these procedures in order to mitigate a potential loss is another focus of underwriters. Lastly, an area that has been heavily scrutinized recently is the use of a PAM tool, a privileged account management tool, where certain users and their credentials are stored and renewed on a regular basis. In fact, each time that user logs into that PAM tool, again using multi-factor authentication to prevent someone with a high level of admin rights being able to work their way around the network that should be very well segmented. So those are some areas of focus. There are lots of others, and everything is increasingly more important as capacity reduces and rates increase, and the demand to make insured look better in the eyes of an underwriter becomes more imperative.
And, something we are trying to sort of communicate to our ship owner clients as well, and many of whom are beginning to implement those sort of security measures, we're pleased to say. The other thing that's probably worth looking into in a little more detail is the fact that, because of this contraction of the availability of capacity, underwriters and insurers and reinsurers are becoming more circumspect in terms of the risks they put on their books, and risk, as you said, risk selection is becoming they're becoming more discerning in terms of what risks they will look at. And, is that sector specific? I mean, how does shipping fit within the sectoral landscape in terms of appetite for risk from these insurers and reinsurers? I mean, I guess some sectors are of more interest and they have more appetite than other sectors. I mean, is shipping viewed as a fairly sophisticated risk, as fairly high risk, or, where does it sit within, I don't know, municipalities or pharmaceuticals, or, where does the shipping sector sit on their sort of risk appetite?
One just then, which is the public sector, municipalities in the US and Canada, where a combination of high risk activities, so high volumes of data, but also very important public services being run by these local government bodies, combined with a very low IT budget, resulting in a very high cadence of ransomware being put on those networks, and an incredibly high loss ratio for that sector in the cyberspace. So, they've certainly felt the brunt of some markets pulling out of that sector altogether. There are others that are perhaps close, or maybe some insurers wouldn't get involved in, like some airlines, for example, casinos, other areas. But on the other end of the spectrum, you've got some, banks and financial institutions which are getting towards, very, very high levels of security. Where, but that's because they have the money, they have the investment in IT security, and frankly, that's been their work and their aim to keep their assets secure even before computer networks were a thing, to the age of the bank robber and the like. So there's a kind of a psyche there. I think Yeah, the marine sector would probably be somewhere in the middle, and it's very important to be able to differentiate your client or yourself in the eyes of the underwriter when it comes to your risk controls, because there is arguably a general view that the investment in cybersecurity has been on the lower end when compared to other industries.
We're in a fairly privileged position here, having had you secure our facility from April this year through to April next year, given the macro changes in the market. I guess what I'm hearing from you from an open market placement perspective is now is not really the time to be seeking terms with the constriction in the capacity and the increase in rate. I guess one would hope that from an open market perspective, as from 1/1 next year, there might be a bit more capacity availability and a lessening of that rate, perhaps. So, yeah, I mean, Shoreline are in the fortunate position where we can still offer our maritime cyber insurance to both the commercial shipping and the yachting sector, subject to the 5 million limit for commercial and the 1 million limit for the yachts. But we are beginning to see a lot more interest in that product. And we are, as I say, in the fortunate position, we're still able to offer that at this difficult time in the market. I think all that's left to say, really, Tom, is thank you for taking the time to speak with us today, and thank you for your ongoing support in helping us to move our program forward with our ship owner clients. And we thank you for managing the relationships we have with our trusted reinsurers in the Lloyd's market. And all we can hope for is that the landscape improves, and I'm sure it will as more and more companies become attuned to the risks that their companies face, and more money is invested in improving the training and the cyber resilience required to resist these attacks. And so hopefully, we can continue to provide this service to our ship owners for many years to come.
Yeah, to be fair, to leave on a bit of a positive note, I think what we've seen through this cyber market, and for the record, I don't think cyber insurers are exiting this class. I think most major insurers are understanding that this is an area that is increasingly important to their clients and needs to be solved and underwritten and transferred to the insurance market. So there is an adjustment happening. I think the rating environment will probably continue to increase, but maybe a slightly less aggressive tack. But the market's here to stay, and I think that what we've seen over the last kind of 10 years of cyber insurance is, as issues have arisen, the cybersecurity community have risen to that challenge. And we're seeing that with the tools that are being requested to be implemented to prevent ransomware and to assist with driving down those instances of loss. And it's important that the insurers implement those, understand that the coverage will be there, and then work with insurers to be prepared for the next issue. There's a lot of positives coming out of the US, for example, with the ransomware task force that President Biden has put in place to try and make it a little less lucrative for criminal organizations to perpetrate these crimes, as well as the technological company, the cybersecurity companies coming to the aid of clients to protect their network. So it's an evolving issue, but I do believe the cyber insurance market will be here to help with that, and it's not going anywhere. We haven't seen a huge amount of markets, if any, pull out of the class. They're just having to re-underwrite and re-understand how to get back to profitability, because it's been pretty close to unprofitable for a couple of years.
Thank you for listening to Shoreline's Maritime Risk Podcast. Today, I, Thomas Brown, Shoreline CEO, have been in conversation with AcrisureRe's Tom Kwai, a leading cyber insurance and reinsurance expert. We hope you found the content useful and informative, and we look forward to welcoming you back when we publish our next in the series of Maritime Risk Podcasts. Thank you.
We'd like to thank the show's sponsor, Maritime Insurance Solutions Limited. The world and life at sea is changing on a daily basis. Shipping companies and owners are facing evolving threats, from political risk to increased maritime cyber risk. Shoreline has the maritime insurance answers you need to make sure your company is covered when crisis strikes. Shoreline are providers of specialist maritime cybercrime and crisis response insurance policies. To learn more about these specialist covers, visit www.shoreline.bm today.